Yo, what's up, y'all? It's your boy, Jay, and today I'm breaking down something major. How do banks actually make money? Like, not for profits, but how they create money out of thin air. Let's get into it. Let's say you deposit $1,000 into your bank. You think it just sits there in a vault, right? No. The bank keeps a small piece, maybe $100, and lends out the other $900 to someone else. That person spends it. The money gets deposited again. Then that bank lends it out to someone else, and the cycle keeps going. This is called fractional reserve banking, and it means banks are literally helping create money just by lending it out. So who makes the rules for how banks can lend? That's where the Federal Reserve comes in, aka the Fed, aka the boss of all the banks. The Fed controls how much money banks have to keep locked up. If they say, yo, keep less, then the banks can lend more, and more money hits the streets. They also set interest rates. Lower rates equals borrowing gets cheaper. Cheaper loans equal people spend more. More spending equals more money flowing. But if banks and the Fed keep pushing money into the system, that can cause inflation. Inflation means prices go up. Your dollar buys less. Picture 3 kids, all with cash, trying to buy the same bag of chips. The seller sees all that money and says, now it's $10. That's inflation. More money in the system, but not more stuff to buy. Alright, let's break it down one more time. Number 1, banks lend money, and that creates more money. Number 2, the Fed controls the rules and interest rates. And number 3, too much money out there, that's how we get inflation. So yeah, now you know. Banks don't just hold money, they help build the money we use every day. If you learned something new, smash that like button, subscribe so you don't miss the next breakdown. And yo, drop a comment. Where do you think money really comes from? And remember, the only people who get it are the people who get it. Make it a great day, and thanks for watching J Game. Goodbye.